If the watchdogs are being fed steak by the wolves, who is left to sound the alarm for the sheep?
In the dazzling, hyper-competitive landscape of 1990s corporate America, one star shone with a blinding, almost unnatural intensity: Enron. It wasn't merely a successful company. It was a cultural phenomenon, a revolutionary titan that promised to reinvent the very DNA of the market. Its headquarters in Houston pulsed with an aura of invincibility, a modern-day Camelot attracting the sharpest financial engineers, the most ambitious MBAs, and the most credulous investors from around the globe. The world watched, mesmerized, as its stock price chart resembled a rocket ship, a seemingly unstoppable ascent to a pinnacle where traditional rules of business physics no longer applied. Wall Street analysts sang its praises, and Fortune magazine crowned it America's most innovative company for 6 consecutive years. But behind this glittering facade of success, a chilling and deliberate illusion was being engineered.
What if the very foundation of this trillion-dollar empire was nothing more than a digital age mirage, sustained by psychological manipulation and technological sleight of hand? And when the illusion finally shattered, who would be left holding the pieces of their broken dreams?
Enron's origin story reads like a classic American tale, beginning as a humble merger between 2 stodgy natural gas pipelines in 1985. But under the leadership of the charismatic Kenneth Lay and the ruthlessly brilliant Jeffrey Skilling, it underwent a metamorphosis. Skilling, a former McKinsey consultant, didn't just want to sell gas, he wanted to financialize it. He pioneered the gas bank, a revolutionary concept that transformed predictable energy commodities into volatile, speculative financial instruments. The company aggressively lobbied for and thrived on deregulation, positioning itself as a maestro in the new, chaotic symphony of the free market. It expanded with voracious appetite into weather derivatives, broadband fiber optics, and even exotic markets like advertising time, all while convincing Wall Street it possessed a proprietary intellectual magic no one else could decipher.
The business world, hungry for a new paradigm, showered it with accolades. But this relentless pursuit of innovation came with a dark corollary: an unspoken contempt for the mundane realities of profit and loss. Was this genuine, world-changing genius? Or was it a sophisticated Ponzi scheme disguised as corporate evolution, destined to collapse under the weight of its own complexity?
Beneath the glossy surface of success festered a cancerous growth of financial engineering, masterminded by Chief Financial Officer Andrew Fastow. The primary tools of this deception were special-purpose entities, SPEs, not merely dry accounting vehicles, but shadowy parallel companies with names like Raptors and Jedi, designed to be both legally complex and intentionally opaque. These SPEs weren't just for risk management. They were elaborate dumping grounds, used to systematically hide billions of dollars in catastrophic debt and toxic assets from the company's balance sheet. In a breathtaking act of financial alchemy, Enron would transfer its mounting losses to these off-book entities, often controlled by Fastow himself, who profited personally from the deals. In return, the SPEs would provide Enron with phantom capital or fake profits, creating a dazzling illusion of financial health and boundless profitability. This intricate, deliberately convoluted web of thousands of transactions was a fortress designed to be impenetrable to outsiders, making it impossible for investors and regulators to see the rotting core.
If the financial statements, blessed by the esteemed auditor Arthur Andersen, were a masterfully crafted lie, then what did that say about the entire system of trust that the global economy was built upon?
The deception was not a secret confined to the executive suite. It was the toxic lifeblood pumping through the corridors of Enron. Under Skilling, the company cultivated a rank and yank system that pitted employees against each other in a brutal, Darwinian struggle for survival. The smartest guys in the room were rewarded not for ethical rigor, but for hitting aggressive profit targets by any means necessary. A pervasive culture of arrogance and secrecy silenced dissent. Employees were actively discouraged from asking difficult questions, their careers and lavish bonuses hanging in the balance if they dared to challenge the official, triumphant narrative. The company's famed deal-making culture celebrated those who could structure the most complex, opaque transactions, regardless of their economic substance. This environment of fear and greed ensured that even those who saw the glowing red flags of impending disaster chose to look away, becoming unwilling accomplices in a conspiracy of silence.
How many people do you think lay awake at night, knowing the truth but rationalizing their silence with the soaring value of their own company stock? At what point does complicity become guilt?
The Enron scandal was magnified 1,000-fold by the catastrophic failure of the very institutions sworn to protect the public trust. Its external auditor, Arthur Andersen, one of the Big Five accounting firms, was not just asleep at the wheel. It was an active co-pilot in the deception. Earning millions in lucrative consulting fees beyond its audit work, Andersen had a glaring conflict of interest. Its partners overlooked, justified, and even helped design the very accounting tricks that were defrauding investors. When concerns were raised internally, they were suppressed. Meanwhile, regulatory bodies like the Securities and Exchange Commission, SEC, hamstrung by political pressure and a philosophy of light-touch regulation, failed to intervene effectively even as the warning signs, the inexplicable profits, the cryptic financial footnotes multiplied in plain sight. Credit rating agencies, paid by Enron itself, lazily maintained its investment-grade rating until the ship was half submerged. This collective systemic betrayal provided Enron with a veil of unimpeachable legitimacy.
If the watchdogs are being fed steak by the wolves, who is left to sound the alarm for the sheep?
Every empire built on lies awaits its moment of reckoning. For Enron, the first thread was pulled by a single, skeptical voice. In August 2001, Vice President Sharon Watkins, a gutsy internal whistleblower, anonymously sent a memo to Ken Lay warning that the company would implode in a wave of accounting scandals. Almost simultaneously, financial analyst Jim Chanos began publicly questioning Enron's inexplicable profitability. The intricate web of SPEs, designed for perpetual concealment, began to violently unravel. As journalists dug deeper, investor confidence evaporated, causing the stock price to go into a death spiral. The SEC launched a formal investigation, swiftly uncovering a vast landscape of fraud. The death blow came when Dynegy, a competitor, abandoned a planned merger, leaving Enron with no lifeline. On December 2, 2001, the Mirage vanished. Enron filed for what was then the largest corporate bankruptcy in U.S. history, instantly vaporizing $74 billion in market value and shattering thousands of lives.
The proud titan was revealed to be a hollow shell, its throne room empty, its gold painted lead.
The collapse of Enron was not a financial abstraction. It was a human catastrophe of staggering proportions. Just days before the bankruptcy filing, the company locked its employees' 401k retirement plans, preventing them from selling their Enron stock as its value plummeted to zero. Overnight, lifelong savings vanished. Thousands of dedicated employees were not only cast into unemployment, but were also handed their final paychecks in worthless IOUs. The psychological toll was immense. These were people who had bought into the cult of Enron, only to be betrayed by their leaders. Investors, from large pension funds for teachers and firefighters to ordinary families, watched in horror as their life savings were wiped out. The shockwaves triggered a crisis of confidence that froze credit markets and sent global indices tumbling. The city of Houston entered an economic depression. The event served as a brutal, real-world lesson that corporate fraud is a violent crime whose victims are real people, their futures irrevocably altered by the greed of a select few.
How do you measure the true cost of a shattered trust, a stolen retirement, or a broken community?
In the scandal's aftermath, a massive legal and investigative machinery roared to life. The U.S. Department of Justice launched a task force that resulted in over a dozen convictions. The world watched the high-profile trials of Ken Lay, Jeffrey Skilling, and Andrew Fastow. Fastow, the architect of the SPEs, cooperated with prosecutors and received a 6-year sentence. Skilling was sentenced to 24-year, later reduced, and Lay was convicted on all counts but died before sentencing. The real symbol of the systemic failure, however, was the demise of Arthur Andersen. Convicted of obstruction of justice for its mass shredding of Enron documents, the 89-year-old accounting firm was forced to surrender its licenses and cease auditing public companies, eliminating 85,000 jobs worldwide. The public outrage was so potent, it forced a fundamental rethinking of corporate governance.
But as the prison doors closed and the headlines faded, a lingering question remained. Were these individuals merely the most visible symptoms of a disease that had infected the entire system? A disease that required more than just a handful of scapegoats to cure?
Enron's implosion left an indelible scar on the American psyche, serving as a permanent, stark warning about the toxic combination of unchecked greed, corrupted expertise, and regulatory capture. Its most significant and enduring legacy was the birth of the most sweeping corporate reform since the Great Depression, the Sarbanes-Oxley Act of 2002. This landmark legislation sought to rebuild the shattered walls of corporate governance. It established the Public Company Accounting Oversight Board, PCAOB, to oversee auditors, forced CEOs and CFOs to personally certify the accuracy of financial statements under penalty of jail time, and demanded ruthless internal transparency and controls. These reforms were designed to restore faith and create a system where such a collapse could never happen again.
But in today's even more complex financial landscape, with shadow banking, cryptocurrency, and algorithmic trading, are we truly safer? Or have the smartest guys simply moved to new, less regulated rooms, designing the next generation of illusions? Does the spirit of Enron live on, not in energy trading, but in the dark corners of the modern market? We have meticulously traced the audacious rise, the intricate deceit, and the spectacular fiery fall. We have seen the laws rewritten, the courtrooms filled, and the guilty punished. We have analyzed the systems and the psychology. But the most haunting, the most profoundly disturbing question remains, echoing in the silent, polished halls of every modern corporate headquarters and in the mind of every investor. What if the most brilliant, celebrated, and trusted enterprise you believe in today the one praised on every magazine cover, the stock every expert tells you to buy, the company that seems to redefine the future, is hiding a secret of Enron's magnitude, but with even more sophisticated digital camouflage. What if the very signals of its unprecedented success, the complex innovation, the charismatic leadership, the impenetrable business model, are the very clues to its deception?